So after some volatility, the TSX coming back after that 500-plus point loss earlier in the week. Let's go to Jason Vicario, portfolio manager at Hillside Wealth Management with IA Private Wealth, to talk about this. Thanks for your time.
Thanks for having me.
So with the strength of the North American market so far, do you expect to see the run-up carry on until the end of the year?
My crystal ball's in the shop. We don't play the macro prediction game. So to be fully transparent, I can't answer your question. I have no idea.
Okay, so what's your take on the strength so far we've seen?
Well, I mean, there are areas of the market that look frothy to us. There are areas of the market that we're finding some value. We're also finally finding value outside of North America. So to the extent that there are areas of the market, such as AI focused, that are I would suggest frothy, certainly a lot of future expectations built into them. I think investors would probably want to be cautious. We like to say at Hillside that we like to bet on the winner of the race once the race has started. I would suggest that the AI race is, probably in the starting blocks. It's not clear to us who will be the winners in that space. And yeah, like I said, there are areas of the market where we're finding value.
Okay, so tech, we had a big run up a lot of the year, but are you seeing investors begin to pivot to other sectors at this point?
I would say no. I would say, if anything, the retail investor, I hate to use the word dumb money, but they seem to be doubling down. I do glance at Reddit and Substack.
Okay, Jason, we can't hear you. I guess we're having an audio problem. We will see if we can try to reconnect with him. Let me try one more time. You're there. Okay, we can hear you now. Sorry, we cut out at the start of your answer. We were talking about whether or not you see investors putting money beyond tech.
Right. So anecdotally, looking at Reddit, Substacks, some of the things, Twitter, some of the things that I look at just out of, curiosity more than anything, I would suggest that that isn't the case. It seems like the retail investor is certainly looking to things that have gone up a lot, be it gold, be it crypto, be it, I would suggest, let's say, tech stocks that don't really have much earnings or much history. So I'm not necessarily seeing that yet. With the markets at all-time highs, with the NASDAQ strong performance, I would suggest that we're not seeing that shift yet.
Okay, and with tech where it is, are you advising investors or others to put money still into it? Is there room for it to grow?
So when you're looking at a risk asset, the forward rate of return is a function of the yield of the earnings, the growth of the earnings, and then any sort of expansion or contraction of that multiple. When you're buying a stock that's trading at 50 or 100 times earnings, we could just walk through that. So the earnings yield is 2% or 1%, depending on what you think that company can grow their earnings by. And then the last factor, which is that multiple expansion or contraction, when you're starting off with a multiple of 50 or 100, you can't assume, at least I wouldn't in good conscience assume, that you're then able to go to sell that asset at 200 or 300 times earnings. So presumably there's going to be some multiple contraction when you're starting at these lofty multiples. So, that's difficult to answer. If you look at a predictable business, for example, a Meta or a Constellation Software or a Microsoft, it's a lot easier to run the math on those types of securities. And while some of them are relatively overvalued, like Microsoft and Constellation, I would suggest that Meta at 27 times earnings is probably reasonably valued and probably does offer reasonable and even maybe above average long-term rates of return for the long-term focused investors. So it really is, in my view, stock specific. I hate to sort of make a blanket statement, but we own Meta, we own Microsoft, we own Constellation Software. These are tech companies, and so we think that the forward rate of return is going to be strong for those companies.
Got it. Okay, let's get to a couple of stocks you do like. One of them is Curves, which used to operate in North America as a gym, but now is more of a success in Japan. Tell me about it.
Yeah, so I mean, Curbs, I think all of us in North America were familiar. I mean, this was a franchise that was started in Texas, and it was a gym that was really catering to women. And it's struggled in North America. I mean, it's actually relatively defunct, but they found a niche or a high level of interest with middle-aged women in Japan. They have over 900,000 subscribers. They have about 2,000 of these Curbs gyms, and it's a 30-minute exercise program that helps, for the most part, middle-aged women stay fit and healthy, which is kind of funny and ironic if you think about it, because, of course, the Japanese are known to be relatively healthy and live very long lives. And maybe this is why, because they are more in the sort of preventative game than the reactive game in terms of their health. So we like the company. We think that they can continue to add subscribers. We think that they can continue to cross-sell their existing subscribers in terms of protein and merchandise. We really like the subscription model, very predictable. And the stock is still relatively has relatively good value at, I believe, somewhere around 16, 17 times earnings.
Okay, let's get to your next pick, which is Christian Dior. I'm wondering how luxury's been doing lately.
Yeah, so luxury has been struggling. You don't often get to buy high quality on sale unless there is some sort of glitch. Our job here at Hillside is to determine whether this is a short-term glitch or a long-term glitch. And when we're looking at brands like Louis Vuitton, Dom Perignon, Moet Hennessy, et cetera, these brands, some of them have been around for literally hundreds of years. So we think that the short-term retrenching of consumers is just that. This is a short-term issue. We believe that the franchises that Dior owns, and just to be clear, Dior's only asset is shares in LVMH. And LVMH is the 75 brand conglomerate that has been curated by Bernard Arnault. And we think that those brands continue to be strong, continue to be delighting their customers. And we think that the fact that the stock was down 40, 50% from highs represented an opportunity. And again, coming back to the earlier discussion we had, let's say Dior was trading at 30 times earnings. Now off 50%, it's trading at 15 times earnings. All things being equal, if we assume that this is a predictable business, and of course we could be wrong, but we think that, as I said, these brands have long staying power, then the forward rate of return of Dior at 15 times earnings is substantially higher than it was at 30 times earnings. And so that's how we think. Okay,
let's get to your last pick, Novo Nordisk, which is in the middle of a shakeup. Are you betting on a new management team to change things?
Yes, so this is an accurate description, absolutely. I wouldn't say that we're necessarily betting on the new management team to shake up things. What I would say that we are betting on is that Novo Nordisk is a 104-year-old business. They are the only exclusively diabetes-focused business that exists. They have a very, very long-term track record of being the market leader in insulin products, and they now, of course, have become the market leader in weight loss products, which also can be used to treat diabetes. It's a bit gray in terms of what the indications are for these treatments. But we are betting that the leading position that they have in insulin and the leading position that they have in weight loss will endure. That is the sort of the thesis of the moat, if you will. And we do think that, I want to choose my words carefully, but I do think that maybe they became a little bit complacent in terms of that leadership position with insulin, and that they just assumed, okay, well, now we have, Ozempic and Wegovy, and, we created this industry and this product, and we will therefore dominate it just like we dominated insulin. And Eli Lilly saying, hey, whoa, hang on a second here. We've also got some, competing drugs that are actually perhaps even a bit more effective, and they're now taking market share from Novo. And so I think in terms of the question that you just asked in relation to the management shakeup, I think the board and the foundation that controls Novo Nordisk has seen that perhaps the company needs to be a bit more nimble. And so I think that, we feel that, again, so this stock is off 60%. It's now down to 13, 14 times earnings. We think a lot of the bad news is priced into that. And we know that the company is going to continue to grow. And we feel that they're going to maintain and grow their dominant market share positions. And that is why we have decided to take a position.
All right, Jason, I've got to leave it there. Jason Del Vicario, Portfolio Manager, Hillside Wealth Management.